Guys, we're going to talk about the urgent. It's really an urgent call to understand sort of what's happening with the Fed rate cuts, as well as how to invest your money when rates ultimately come down. Because I believe that rates are going to be coming down. And when I say rates, I'm just going to jump right into it. I'm saying rates, talking about the Fed funds interest rate or the Fed funds rate. Sometimes you hear it called, right? As you come in here, guys, do me a favor. Let me know where you're coming from. I'm going to try not to go to my face, but let me know where you're coming from. Where you at? What city, what county, what country, what jurisdiction, what continent do you reside on? All right. Let me know that as you come in here, guys. And I appreciate you spending some time with me this morning. Thank you so much. But we got to talk about the Fed. We also got to talk about, I want to kind of talk a little bit about unemployment as well. Um, I, the Fed may end up cutting the rates, the interest rates, lowering the Fed funds rate at least a couple of times this year. As an investor, as a consumer, we need to kind of know what's going on, right? So that's what's on the agenda today. Excuse me. All right. So we are going to also mention what happened and what came out yesterday that is a part of this conversation, right? It's the jobs report, and that came out yesterday. So we want to have that kind of conversation about what was on there, right? And then we'll talk about how you should be investing when we see interest rates go down, what you should be thinking about in terms of your money, in terms of growing your money, in terms of um, sort of taking advantage of the opportunities that may exist. Because we are seeing unemployment go up slightly. All right. And when I say go up slightly, I'm going to show you a chart in a second here that kind of explains it. Thank you so much, Nancy. Appreciate you. Omanike from Tampa, Florida. Right? Tampa Bay Buccaneers down there, I think. Hey, happy Saturday to you. Sunset on the ocean. Appreciate you. Michigan is in the house. Is it still winter in Michigan or is it warm in Michigan? I heard Michigan was really beautiful in the summertime. Anaheim, California is out here. Hey, big hero. Good to see you. C Dub. Hey, smart money bro, checking in from Riverside, California. Good to have you. Big hero, by the way, is from Seattle. Good to have you as well. Raleigh, North Carolina. North Kakalaki. Merrill is here. Thank you for being here, Merrill. Cassie, Ohio State, the Art of War. I'm sorry. Is it the Ohio State? Let's say, did you just start it till said upcoming? Not sure what that means, Miss. I'm sorry, Miss Reynolds. Can we ask general questions later? Absolutely. I'm going to go through what's going on. And then if at the end of this or towards the middle, you guys want to throw a question in, put a Q by it, and I'm more than happy to help you. We want to have some sort of a back and forth discussion later, but I want to jump into what's going on with the Fed so we're all clear. Namisha, how you doing? Good to have you here. Crafty Librarian, good to have you as well. Haven't seen you in a while. Phoenix, Arizona's here. Brian, what's up from Texarkana, Texas? Panama Jack. It's hot in Michigan. I come to my northern home in the summer. Oh, northern home in the summer. Okay, we got big baller in here, John. I'm not mad at you. Love from B-More, Baltimore, right? Good to have you here. Let's see, Park Heights, Baltimore. Blessings from Brooklyn, New York. Good to have you. Live video on YouTube said upcoming, not live. I don't know why it said that, Miss Reynolds. I think we're live now on YouTube, though. I think we're live. Let me go over and check real quick. I appreciate you pointing that out to me. Let's take a look real quick. I'm going to jump right into this thing. Let's see here. Boom, boom, boom. Bada bing, bada bing. I'm going to actually just kind of do this. You guys can hear me okay, right? Just give me a thumbs up. Let me know that you can hear me okay. And give me 2 seconds here. Give me 2 seconds, guys. Got to check something real quick. All right. Okay. I think it looks like we're good to go. Yeah, looks like we're good to go. We're nice and live over there. So I appreciate you pointing that out to me, by the way. All right, let's see what we got here. Hey, bro. How you doing? Thank you for the thumbs up, guys. I appreciate it so much. Hey, bro, you're live. Thank you. Thank you. Thank you. Man, where would I be without you guys? Let's talk about this. Okay, so the Fed, the Fed's the Fed funds rate, which is the rate that banks charge one another for overnight lending, really, really short term, week, 2 weeks, right? They lend money to one another if they're under the Federal Reserve System, which most banks are, right? So these banks, they loan money to each other. And just sort of recap, they loan money to each other at a certain interest rate. And that interest rate is what's called the Fed funds rate. Right now, the Fed funds rate is hovering between 5.25% and 5.5%. So that's the rate that banks charge one another for overnight lending, the Fed funds rate. When you hear them say, "Oh, we're gonna increase or decrease the Fed funds rate," and they come on TV, they have a press conference, they're talking about this Fed funds rate, right? So the Fed funds rate is has it increased. I think summer of 2022, inflation had got crazy. Prices were going up at a fast rate, 7, 8, 9%. That's high inflation, higher than we're used to. Not high like the 80s. In portions of the 80s, we had 12 and 13 and 14% inflation rate. But it's high for what we're used to. So the Fed said we're going to raise our Fed funds rate from 0%, near 0%. We're going to keep raising it up. And they kept raising it up. And every time they raised it, what happened was it made the what do you call it? The interest rates, our interest rates go up, because when the Fed raises the interest rates that banks charge one another for overnight lending, the banks pass that on to us. Short-term loans, right? So the bank says, okay, we're charging 5.25% and 5.5%. Now we're going to increase automobile loan rates. Now we're going to increase the rate that you want to come and get a loan from the bank, a small $10,000 loan. We're going to increase that rate. We're going to increase the rate that that's on your credit cards, because those are short-term loans as well. So everything gets passed down to us when interest rates go up. But when interest rates go up, it deters people from spending money, right? So people spend less money when interest rates go higher. They spend less money because now money is more expensive to borrow, right? So all that's happening in the background. That's what's happening with the Fed funds rate. Yesterday, the Bureau, I can barely say it. Well, let me say this. The Fed's mandate that they talk about they want to do, the whole purpose of the Fed, I'm going to jump around a little bit, but stay with me, guys. The Fed wants to do two things, and they talk about it every time they come and have their press conference, right? After they have one of the 8 meetings every year. The Fed gets together 8 times every year to decide what they're going to do with that Fed funds rate. They look at all the stuff going on in the economy, GDP, the price of this, the price of that. They look at unemployment. That's a big piece. They look at all these things and say, you know what? Let's raise that rate a little bit. Up. You know what? Let's lower that rate a little bit. Up. You know what? Let's keep that rate exactly where it's at right now, right? So for a good year, they raise the rates incrementally higher and higher and higher, making money more expensive to borrow, right? And so then they said, wait, for the last 7 times they've met, I think it's 7, maybe 8 times they've met, they said no more raising the interest rates. We're done raising the interest rates. All right? We're done raising. When they raise the interest rates, it makes money more expensive to borrow. Consumers don't want to borrow. Businesses don't want to borrow or can't borrow. And it kind of slows down the economy, so to speak, slows down the spending in the economy. So they said, you know what? Maybe we need to cut rates, right? And this is what I think is going to happen. I think this is going to happen. I'm just going to put it out there up front, beginning of the video, at least a couple of times this year. I think they're going to cut rates, and I'll tell you why on this video here, as we talk about unemployment, as we talk about how to invest during this time, right? So the Bureau of Labor Statistics came out yesterday with their jobs report, and it revealed a couple of important things that we'll talk about here in just a moment. Um, but I want to bring this all to your attention because we are investors, we are consumers. We are investors, we are consumers. We are regular, everyday retail investors, and we are consumers. And because we are regular, everyday retail investors and regular, everyday retail consumers, we got to know what's going on in the economy. And that's what we're talking about. And sometimes I don't do these videos a whole lot, but I think sometimes when we have something significant that happens that sort of flies under the radar, nobody really talks about it too much. I think it's important to mention. I think it's important to talk about, right? This affects you, right? Whether you see it or feel it or you don't, it kind of affects you. Now, full disclosure. I always give a full disclosure. I don't know why. It just sounds really cool to do a full disclosure, right? You ought to try it one day when you're just chilling by yourself. Hey, full disclosure. So, full disclosure is this. This is out of your control. There's nothing you can do about it. There's nothing you can do about whether the Fed raises rates or doesn't raise rates, right? It's out of your control. A lot of times on this channel, I tell you, don't worry about things financially that are out of your control. But I don't want you to worry about this, but I do want you to know this. Okay, a little different there. Right? Don't worry about it, but be aware. That's all. That's what we're doing here, right? So the labor market, the labor market, what's happening in unemployment, that has an effect on you and an effect on the investment world. It's kind of an indirect effect, but it's there, right? So the unemployment numbers, the numbers that came out yesterday, we'll talk about that, and then we'll talk about how it affects you and all that good stuff. June 2024, the U.S. added 206,000 non-farm jobs, right? Gains in government jobs were added, gains in healthcare were added, gains in the construction area was added, and we'll look at it. I'm going to pull up an article real quick. But the unemployment rate has ticked up. I was making a video like this 6 months ago. The unemployment rate was at an near all-time low at 3.5, 3.6%. The unemployment rate today, as of yesterday when it was reported, is 4.1%. Doesn't sound significant. The unemployment rate is still relatively low, but there is an uptrend. So what you have to know first and foremost is that unemployment, unlike the stock market, which is a forward-looking measure, unemployment is sort of a lag measure. Unemployment is sort of what takes place after all the things that are trickling down. Money is more expensive to borrow. People are spending less, right? The ultimate result of that is unemployment, but we don't see unemployment, the effect on unemployment quickly, all right? The effects on unemployment have to happen after a while. So it's taken a while, but as we look at the last 6 months worth of numbers of unemployment, we see that it's steady going up, right? And I'll show you a chart in just a moment to illustrate that, right? And so that's important. Matter of fact, let's do it right now. What are we waiting on? Like, what are we waiting on? Let me pull her up right now. Let me just kind of run through an article real quick, guys. I like to share my screen, so bear with me. Appreciate you being here. Let me see if we catch up here on that. Jerome Powell is keeping all of this a secret. Look, the Federal Reserve, they got to keep some stuff secret, right? I always say this, the Federal Reserve is just as much a communications company as it is a company that's controlling the interest rates, because what they communicate to Americans matters a whole lot. So they have to sort of keep things a secret. I say have to. They don't really have to, but they feel they have to because of sentiment, panic, etc. Right? So they can't get bad press and all that good stuff. They're really worried about that big time. And so they keep things sort of hush hush, or they monitor exactly what they say and how they say it and all that good stuff, right? Let me see if I got the right boom, 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 boom. All right, man, I got all kind of stuff up in front of me, guys. Give me a second here. I'm going to see if I can pull up my screen. Not sure if I can or not, but we'll try it. Let's see what this is. Nope, that's not the right place to be. That's the right place to be. All right, so give me a second here. I'm slow, man. You got to work with me. I'm an older guy, right? As an older guy, I mean, I move a little slow sometimes. I don't flip around this stuff too much like some folks. All right, so this article came out yesterday, and you guys can see my screen. Hopefully, you can see it. If you're not, come on over to YouTube and check us out there, and you can check it out. So, U.S. economy added 206 jobs in June. Unemployment rate rises to 4.1%. Non-farm payrolls increase. These are some of the highlights. Let me go ahead and run through it. The U.S. economy again added slightly more jobs than expected. So it did add slightly more jobs. However, the unemployment rate increased. Non-farm payrolls reached for the month better than 200,000. It was they predicted 200,000 new non-farm jobs, and non-farm jobs came in at 206,000. Now, non-farm jobs do not include farm workers, agricultural folks, active military folks, private household employees, right? Nannies and things like that, or nonprofit organizations. So non-farm jobs don't include those things, right? So when we say non-job farms, we're talking about jobs at businesses, private sector businesses, et cetera, right? Government agencies is included when we talk about non-farm. So 206 non-farm jobs created, higher than the forecast, right? And you look at their monthly job creation. And what do you notice about this chart, guys? What you notice about the chart is it's steadily kind of decreasing, had a really low down there in April of 2024, but it's steadily sort of decreasing from where it was a year and a half ago, right? The unemployment rate unexpectedly climbed to 4.1%, tied for the highest level since October of 2021. That's that's nearly 3 years, right? So we're looking at, unemployment is still fairly low, but we're looking at unemployment creeping up. Creep, right? And it says it's providing a conflicting sign for the Federal Reserve officials weighing their next move on monetary policy. The forecast had been for the jobless rate to hold steady at 4%, but it actually creeped up. It's a soft landing kind of report is what they said. The increase in the unemployment rate came as a labor force participation rate, which indicates the level of working age people who are employed or actively searching for a job, rose to 63%, right? The people who are employed or actively searching for a job slightly rose also, right? The so-called prime age rate, which focuses on the ages between 25 and 54, rose to 83%, right? That's the people who are actively working or looking for work. So what I'm seeing is this, pandemic, gig economy, everybody with a side gig, that's slowing down. Okay. That is slowing down. And as that slows down, people are looking for jobs. People are, and I'm not saying it's slowing down any significant amount. I'm just saying that's a piece of what's happening, right? A broader unemployment rate which counts discouraged workers and those holding part-time jobs for economic reasons held steady at 7.4%. So they have different measures of employment and unemployment, right? U.S. unemployment rate, there's another chart. It says, though June job creation topped expectations, it was due in large part to a 70,000 surge in government jobs. So government's getting bigger and bigger, right? Government jobs they're hiring more for the federal government, right? Also, healthcare, a consistent leader by sector, leader in job creation, added 49,000 jobs, while social assistance contributed 34,000 jobs. So just to show you what's happening with jobs, I wanted to kind of give you a feel for that. And I want to show you one more thing, guys. Look at me. I'm all over the map. Work with me, guys. Don't beat me up. But I want to show you one more thing to put it in more of an illustrative manner, right? So if you look at these two charts right here, U.S. job growth down in June, unemployment rises to 4.1%, right? Just giving you an overall feel here. Notice, what do you notice here on the left? Non-farm jobs, that's the same chart we just looked at here in the green. Non-farm jobs, sort of there's a trend down. Unemployment rate since January of 2022 up until today, right? Notice we had a dip. What happened in that dip right here? The dip right here was sort of the high inflation, higher inflation, etc. Now, what is the trend line looking like in terms of unemployment rate? Excuse me. The unemployment rate is sort of going up, right? We saw 3 months in a row where it was down back in at the end of last year, 3.7%, 3.7%, 3.7%, 3 straight months. Now it's kind of trending up. Now, remember what I said. The stock market is forward looking. Unemployment is a lag statistic. A lot, meaning that it's like a reaction. It's the last thing that takes place is unemployment begins to go up or unemployment begins to change, right? So I wanted to point that out to you, but this is unemployment has risen steadily over the past year. Another great chart at Yahoo, right? And it's showing that over the past year, this is what's happening to unemployment. Now, this is something that, again, 4.1% is still fairly low. But I want to preface everything we're going to talk about with this unemployment information, right? So I just want to give you a feel for that, right? Sidebar conversation here, quickly, sidebar. Since we're talking about unemployment, as you may or may not know, when the Federal government, not the Federal Reserve, when the federal government measures the unemployment rate, they measure it, it's the share of workers in the labor force who currently don't have a job, but they're actively looking for a job, right? People who have not looked for a job in the past 4 weeks, they're not counted in that unemployment rate. That's why some people say, well, that's a fake measure, right? So how does all this affect stock market? How does all this affect businesses? How does all this affect investors? How does the Fed funds rate affect stocks, right? Remember, for 2 years, guys, we saw the Fed funds rate go higher and higher and higher, trying to slow down spending and cool inflation. Because, again, when the Fed raises the rates like that, typically when the Fed funds rate goes up and money is more expensive to borrow, the stock market sometimes takes a hit, suffers a little bit. Because money is more expensive to borrow, businesses can't grow. Here's why that hasn't happened this time. Because as we talked about last week, the main thing that's driving the stock market now is what? Tech stocks, right? Low overhead tech stocks. Tech companies, right? Tech companies are driving the market really the last 4 or 5 years. If it wasn't for tech stocks, stock market wouldn't be doing as great as it's doing, right? We know that, right? Or we got to keep that in mind at least, right? So typically when the Fed fund rate goes up and money is more expensive to borrow, typically the stock market stays steady or doesn't grow as much because businesses can't borrow cheap money and consumers can't borrow cheap money. And that means businesses can't grow as much as they normally grow and revenue suffers, et cetera, right? And debt is more expensive. All that stuff happens. The whole difference in terms of what's going to take place now, I think in the next couple of months, is the Fed is going to start lowering these rates. So raising rates says, don't go out there and spend money. We raise the interest rates. Money's expensive to borrow. We want you to slow down your spending. Lowering the Fed funds rate from 5.25% to 5.5%, the money that banks borrow from one another, when they lower that rate, it incentivizes and pushes and encourages spending, right? And when the Fed funds rate goes down and money is cheaper to borrow, stocks tend to do better. We're not talking about the outliers. We're not talking about the tech stocks, the Nvidias, right? Those are the outliers. But generally, generally speaking, the market as a whole usually tends to get a little bit of stimulant when money is cheaper, right? Because it incentivizes consumers to consume. Hey, money is cheaper. Let's go charge and borrow money. It incentivizes businesses to go out and, buy that piece of equipment or whatever. Ultimately, businesses tend to do better, stocks tend to go up. I think the Fed is going to cut rates 2 times this year, right? I think the Fed is going to cut rates 2 times this year. The other thing I'm not going to bring in too much of, but the GDP. GDP is going down slightly as well. GDP at the end of last year, over 3%. GDP at the beginning, first quarter this year, 1.7, 1.6%, right? GDP is the overall measure of the total cost of goods and souls, finished products in the course of a quarter, right? So GDP going down. Businesses sort of suffering. IT killing the game in terms of revenue, in terms of keeping the market afloat, right? So less jobs being created. We saw the trend, less jobs being created, unemployment slightly going up, just a little bit. So the Fed has to play this balancing act. And oftentimes, guys, as retail people, as consumers, we don't see or understand the balancing act. All we see is, oh man, prices are going up. Let me jump on Facebook and give a bad post, or let me jump on Instagram and say something about the bad economy or something. We as sometimes as retail investors and consumers, but you got to be a little more savvy as an investor. You need to probably think about the big picture and what's happening in the big overall picture, right? And I'm not here to, bash anything necessarily. I'm just here to give you information, because sometimes you just need regular information that's not from CNN, and it's not from Fox News, and it's not from MSNBC, and it's not from, you just need somebody to give you regular information so you can go out and make an informed, intelligent decision and not be swayed by my politics or who I like and who I don't like and what agenda I have. There's no agenda here, just to give you this information so you're informed. All of this stuff is tied together. Unemployment, federal funds rate, stock market, it's all tied together, right? And as an investor, you got to know that there's more things that are having an effect on your individual stocks or your ETFs. There's more things that are having an effect on that from the outside. Excuse me. So later, in just a bit, I want to talk about how you should be investing and things to consider when these rates go down, when the Fed lowers the rates. By the way, hit the thumbs up button for me, guys. Tap that thumbs up button. Appreciate it. Just want to take a quick commercial break because I've been going in, haven't even checked the chat like I normally check. I apologize about that. But do me a favor and hit the thumbs up button as you come in, guys. Also, do me a favor and check out the links below in the description box. Also, check out my partner on this one, Mint Mobile. Save some money on your premium wireless services. Why? They don't have box stores called Mint Mobile on the corner of Main Street. There's no box store. There's no employees. Everything is done online, and it's excellent customer service. It's fast. Takes about 15 minutes if you want to change over and get much, much less expensive premium wireless service on Mint Mobile. There's a link to that below. 24 Laws of Money free ebook is in the description box below also. And you can join our other membership site where we actually spend some time digging a little deeper. I haven't done a whole lot over there yet because I'm waiting to get a few more people in there, which we got a couple of hundred folks in there. So we're going to be doing some stuff. Matter of fact, I'm going to do a video that's exclusive to that site probably in a day or two, talking about individual investing strategy with individual stocks, right? You guys are going to hopefully follow me along over there. Follow me along over there with how I take some money and we're going to grow some money together. But how does unemployment affect your stocks, your investments, right? Again, always keep in mind the stock market is reacting based on forward looking. It's looking forward. People are making decisions about what to invest, what not to invest. Institutional investors, that's the large people. That's the Sally Mays and the Warren Buffett's, right? These people are looking at the stock market and they're making decisions looking forward, right? But at the same time, unemployment is a reactionary thing that takes place. It's a lag statistic, right? Stock market is wondering what's coming up, right? Because it's natural, right? Our money's in the stock market. What's coming up? We want to see what's coming up, right? So, first thing is this, right? If people don't have the money to spend or are worried about their jobs because of higher and higher unemployment, not that 4.1% is high. Again, that's the relatively low. But as we move on, we could be talking next year at this time and we could have an unemployment rate of 5.5%, right? But when unemployment goes up, people or less jobs are created and people don't have the money to spend, even though the rates are lower. People are worried about their jobs. That influences how they spend their money. And how they spend their money could have an effect on a company's revenues and profitability, right? If you were the cruise lines back during the pandemic, people were nervous and scared about what was taking place. They were nervous and scared. Oh my gosh, my company's losing money. Are there going to be layoffs? Are we going to be? And because of that, that curtailed their consumer spending. And it had an effect on the business's revenue and the business profitability, right? So that matters in turn. That unemployment, people's employment matters when it comes to the stock market. There's sort of an indirect effect. Interest rates, when the labor market gets weaker and weaker, meaning unemployment goes higher and higher, right? Less spending. Less spending. And I think what's happening is as the Fed is seeing the trend, and the Fed is not worried about they're not going to worry, they're not like in desperate worry about 4.1% unemployment. They expect unemployment to rise. Matter of fact, they've been expecting unemployment to rise for the past year. It's just taken a lot longer, right? Yes, the Federal Reserve will come out and tell you we want to lower or not lower, we want to control prices, price stability, and we want maximum employment, right? Excuse me. But maximum employment does not mean we want everybody working. The Fed doesn't want everybody working. Matter of fact, they want to see the unemployment rate slightly go up. That's an indication that their higher interest rates are working, because typically when they raise interest rates, typically unemployment goes up. It just takes a while, which it has taken a while, much longer than they thought. So the Fed sort of wants that to happen, right? And when that happens, you see people spending less money. We've just been bailed out, so to speak. Your stock market has really been bailed out by the tech stocks, right? Point blank. Let's call it what it is. The other thing to think about is this: when unemployment slightly goes up, what happens to retail investor sentiment? It leads us to be a little more skeptical, a little more cynical, right? And it sort of lowers our confidence in what's happening in the economy when we see layoff after layoff after layoff and we see unemployment increasing, right? When people get cynical and worried about their jobs, they slow down their spending. This is why the Fed comes in and cuts rates. Because when unemployment goes up, the Fed says, we can't have people getting cynical and worried about spending money. We have to do what? We have to incentivize them to go spend money. So let's cut rates. Right? All of it is tied together. Right? And also, listen, you got to remember this too. I mean, just full disclosure on another full disclosure, right? I love them. Certain sectors of the economy react differently to higher unemployment, right? Consumer sentiment changes depending on the sector. All right, let's understand that. So these are the interconnections that make the labor market data, the Fed funds rate, all of it important for stock market, for investors that are investing in the stock market, right? What should you do? What should you be considering as an investor when rates get cut? Because they will get cut at least once, but I think twice this year. Because we're going to get another report, another labor market report, another unemployment report the next couple of months. And if we see the unemployment rate hovering at 4.1 to 4.2 to 4.3, that's the incentive. I think one of the large major drivers that says the Fed is going to cut rates again, twice this year. All right. Hey, salute Jay Samuels. I'm looking back at the chat here. Appreciate you. At bare minimum, we need to at least get our employee match with the company 401k. That's an excellent point. Excellent point. At least get the match. Always say get the match no matter what. Always. Right? We don't know about Social Security yet. We don't know if it's going to be gone, being frank. We just don't know. The government needs a percentage of people unemployed and dependent on them to control the money system. Yeah. Then that's why you're never going to see full 100% everybody working, right? Well, if you see full 100% everybody working, you might be in a communist state. I don't know. We'll see what happens, right? Let's see. So first things first, you got to get your skills up. Make sure your skills is up. Make sure your resume is tight, right? Look, let me see if I can find this article real quick. Jobs. Leading companies announcing layoffs or hiring freezes in 2024. Let me see. Besides who's already announced the hiring freeze or some layoffs, let me see if I can't find the article real quick. All right. Leading companies announcing layoffs and hiring freezes in 2024. I think this picks us up in June, right? FedEx, Ford, Zach Holdings, not a whole lot. Microsoft, we know some of the IT firms have already laid off a lot of people already this year. We know that, right? And you're saying, well, IT is booming. Why would they be laying people off? Well, how do you stay? What's the largest expenditure of any business? Usually it's labor, right? When you got a lot of labor, you got to charge a lot of money for your product, and your profit is lower if you got a lot of labor. You reduce labor, profit is higher, etc. Right? Microsoft announced laying off 1,500 workers back in June. Well, this is not up to July. This is backdated. I'm sorry. But there's companies out there. There's websites we can pull up to find layoffs. And once we do that, we see there's a lot of tech layoffs, okay, that have happened. Now, I'm not saying your company's going to lay you off. Don't get it twisted. I'm not saying that. Don't get all up in a tizzy. I'm just saying get your resume right, get your resume updated, get your skills up, right? If the Fed cuts rates, don't go out and be in a hurry to borrow a bunch of money on a car. Oh, my goodness. The rate last year was an 8%. Now I can get a 4% rate. Let me go out and get a brand new car and go ahead and finance it for 7 years. No, don't do that. You don't have to do that, right? Don't be in a hurry to go out and do what they want you to do. Just calm down, relax. You got other people that are gonna fall for that. Chill out. First things first, get your skills up, get your resume right. I tell people every 6 months, if you're out in the working field and you looking for more pay, every 6 months you should be looking around and applying for jobs and seeing what's out there. Not everybody's situation is slightly different, right? We may see that stocks went. Listen, when the rate goes down, that's always a little bit better for businesses, right? Now businesses can borrow money cheaper. When businesses can borrow money cheaper, it kind of stimulates those businesses, right? So we know that can happen, right? Even though unemployment might be raising, all these things happening at one time. But you want to always keep DCAing, in my opinion. Always keep DCAing, dollar cost averaging, into the stock market. Don't be the regular retail investor that throws a bunch of money in, pulls a bunch of money out. Throws a bunch of money in, pulls a bunch of money out. In my opinion, that's the wrong way to invest, because you risk missing the most important days of the market by looking at the unemployment rate and looking at all these outside things and putting your money in and pulling your money out. Don't do that. That's not, I don't suggest that, right? Now, if you're a big time institutional investor and you got $10 million and $30 million, you can play that game, right? When the stock market goes down, you can pull your money out and go put it in some more safer fixed assets like bonds and things like that that are more of a guaranteed 2, 3, 4%, as opposed to leaving it into the stock market where you're going to get a negative 15%, whatever, like we had back in 2022. S&P 500 was a negative 18 in 2022. A lot of institutional investors pulled their money out and went and put their money in more safer 1 and 2% investments, right? You can play that game, but you don't have a team of 20 people who's managing your money like Sally Mae has, who can actually do this thing, right? And look forward and understand the market. You don't have that. So when you go pulling your money out and throwing your money back in, you're missing some of the greatest days gains in the stock market. So I suggest you just dollar cost average your money and keep doing it even as the rates come down and everybody is going to now go out and start buying and so forth and getting motivated to buy because money is cheaper. You don't have to partake in that as a wise consumer, a wise investor, right? You don't have to join the fray. The latest video I put out on YouTube a couple days ago or yesterday said very clearly, if you look at the thumbnail, right? What was the name of the video? I forgot. But if you look at the thumbnail, the name of the video was Money is Easy. Thinking different is hard. And the thumbnail had everybody going one way and had you going a different way, right? That sort of has to be your way of thinking as a good, solid investor and a good, solid consumer, right? The Fed has how many meetings? 4 more meetings, I think, this year. They're going in late July, September, and everybody thinks they're going to cut rates in September. I don't think they'll cut rates in July. I think they'll cut rates in September. I think they'll cut rates again later in the year in either November or December. 4 more meetings this year, right? So for you, instead of borrowing a whole bunch of money when you see rates come down slightly, try investing and keep dollar cost averaging when rates go down, right? And we get hopefully we get a little stimulation in the stock market, may or may not. Everyone's getting cheaper loans. You're out dollar cost averaging, right? The question is, how do you invest when the Fed lowers the rates? This is what you want to do. It oftentimes is going to give you a signal, like it gives everybody else, to start actually spending money. Resist the temptation, right? Your job is to keep doing what you've been doing to get to this point and look for various ways to even diversify your investments, right? Obviously, you're going to be looking at growth stocks, right? Why do you want to look at growth stocks when the Fed fund cuts rates? Because when the Fed funds cuts rate, it's a stimulant to businesses to go out and maybe buy and borrow and et cetera and grow. It makes sense that you would look at growth stocks, right? Put some growth stocks on your radar, right? Because reduced rates means lower borrowing cost for businesses, not just for me and you, for businesses. And lower borrowing costs may end up producing increased profits, right? So growth stocks, which we already see technology is killing the game and has been, right? And stocks in companies that may have like discretionary spending, right? So look, discretionary spending means extra spending, stuff that people don't really need, but they kind of want, right? When rates go down, you'll see a slight boost in automobile companies stocks, right? Because when rates go down, people do what? They go borrow money to go buy cars, and cars see some profitability increased, right? You got to be thinking with this thing. Your wheels got to be turning. Some of you may like your dividend stocks, right? High yield dividend stocks, right? Something to think about. Keep in mind that value stocks that provide strategic dividends, though, they usually do better in down markets, right? not necessarily up markets. But all of this is contingent on a lot of things, a lot of factors. I'm just giving you some things to think about. What about real estate? Do we have some real estate folks in the house? Guess what happens? Now, the Fed funds rate is not directly tied to mortgage rates. Mortgage rates are tied to the 10-year treasury. However, there's sort of a trickle down effect. Think about this. 3 years ago, when the Fed funds rate, that's now at 5.25 to 5%, when it was down at around 0 to 0.5 or 1%, when it was that low, where was mortgage rates? 3%, 3.5%. When the Fed funds rate shot up over the last year and a half, 2 years, to 5.25%, where it is today, what happened to mortgage rates? Mortgage rates shot up to 6 and 7%. They're not directly tied together, but they're indirectly tied together. So guess what happens when the Fed funds rate lowers its rate? It means potentially, maybe, mortgage rates will go down slightly, right? What does that do for the real estate market? It boosts the real estate market, right? So maybe when you're investing, you're talking about, okay, that's the stock market. Maybe I can look at some regular real estate investments too, because I'm going to get a lower mortgage rate as well if I go out and buy a couple of rental properties. Because the housing market gets a little boost as well, right? Making it maybe a good time to invest in real estate, or maybe even REITs, right? Maybe even REITs, right? Real estate investment trust, right? Now, I'm not a big fan of bonds, but maybe as interest rates fall, bond yields typically go up. Sort of an inverse relationship, right? Something to think about. Then you got your corporate bonds. Now, your long-term bonds are U.S. government treasuries, right? Backed by the U.S. government. Your corporate bonds are backed by corporations. A little more risky when you're talking about corporate bonds. I'm not a big bond person in general, but you just got to know there's an inverse relationship. When rates go down, Fed funds rates go down, bond prices typically go up, right? And then, of course, you got your commodities you could look at to diversify, your gold, your silver, things like that, your oil, natural reserves. There's commodities out there that you can think about, right? Then, of course, if you own a home, you can think about refinancing too. Some people got a mortgage rate at 7.5% and rates go down. Ultimately, mortgage rates are going to go down. Then you can refinance as well, right? Take advantage of those, right? These are things that you should be thinking about when interest rates go down, which they will go down. Not sure if it's going to be something like 100 basis points, 50. And when I say basis points, 100 basis points is 1%. So right now, the Fed funds is 5.25 to 5.5. If it goes down 100 basis points, it's going to be between 4.5 to 4.25 to 4.25. 1%. 50 basis points is 0.5%, right? So these are all things you got to look at. I'm just trying to get you guys to be that consumer that's aware, that investor that's aware that what's taking place with Fed funds, what the Federal Reserve decides to do with the Fed funds rate, has a trickle-down effect to how the stock market behaves, has a trickle-down effect to what ultimately happens to the unemployment rate, and it definitely has a direct effect in terms of our spending, consumer spending and business spending, consumer borrowing and business borrowing. And it ultimately has an effect, again, ultimately on unemployment, mortgage rates. All these things are tied together. If you're a regular consumer, the average consumer who doesn't watch this video, you may not understand the interconnection between all these things that are happening in the big picture, the macro economy, right? Now, some of this is beyond stuff you care about. I totally get it. It's not exciting. It's not fun. It's not glamorous, but you should know it. You should know it. Let's see. I'm going to go back to the chat. I haven't been to the chat in a while. I apologize, guys. If you got a question, a Q, drop it up there. If you had a question about anything, stocks, federal government, and as you know, my third full disclosure on the video. I work for the federal government. So I sometimes have to keep up and understand the big picture of things over the last 20 something years, right? So let's see. Somebody says, let me go back a little bit here, guys. Let me see. Okay, go back. September is historically the worst performing month in the market. Is it September or October? I think it's one of those months. You're right. You may be right, Pablo. Appreciate that comment. The other thing to think about is that typically in an election year, this is an election year in America, right? Presidential election year. In an election year, the stock market typically doesn't do that great, right? Not as well as it does the previous year. Somebody said, I'm looking forward to lowering rates. Difference is I'm only concerned this time. I'm only concerned this time that I'm debt-free spending 4% of my income on needs. Okay, cool. Somebody said all these small companies in the S&P going to be the biggest moneymaker as soon as the Fed cuts. You know what? Let's if you invest in the small companies, let's hope so. Small cap companies have had a hard go at it, guys, for the last 8, 9, 10 years. Large caps have been killing the game. Small caps have been floundering. So let's see. We don't know what happens, Jay. We'll see. Going to refinance those pesky student loans. Went from 300K in 2018 to 120K today. Congratulations to you. Congratulations to you getting those things knocked out. Get them knocked out. I'm with you on that. Let's see. A lot of outflow out of technology as soon as the Fed cuts. Perhaps, Jay. Let's see. REITs going up. REITs could go up. REITs have struggled a little bit. There's a big issue going on right now in the commercial industry, guys, as you may know. Stay-at-home fever has happened around the country in America, and you got a lot of empty buildings, and those notes come due, and those things are going to get swiped up. There's like $1 trillion in notes coming due or have coming due. I think coming due later this year and next year. So, commercial real estate is interesting. We don't know what's going to happen with commercial real estate. It's important to remember when interest rates come down, so does the interest earned on your brokerage and savings account. Absolutely. Let me highlight that comment, Mark. Mark is absolutely correct, guys. And if you have a comment and I look at it, I might highlight it. Some of you in the last year, you've jumped into these high yield savings accounts with your money. High yield savings accounts are variable rate accounts. In other words, the interest you earn on them will change, right? They lure you in because they have this wonderful commercial or wonderful advertising on the internet that says, hey, 5.5%, come and put your money here. Great. But as interest rates fluctuate and go down and up and down and up, those interests that you get, your return on your money they change also. Just keep that in mind. Watch your interest rate. I was talking to somebody the other day said, hey, I was getting 5%. Now I'm getting 1%. It happens, right? Keep that in mind. Very good point. Thank you, Mark, for bringing that out. Brooklyn in the house. Good to have you. Let's see. How do we invest right now when index funds, Namisha asks, when index funds are at an all-time high? Let me say this about investing when things are at an all-time high. I'm not talking about individual stocks right now. Boom. Full stop. I'm talking about index funds, ETFs, things that have a bucket of stocks in them. When you're investing, and this could really apply to some stocks as well. If you're investing for the long term, okay, this is why long-term investing is so important. Let me see something real quick. All right, so let's see if I can find a chart real quick. A chart. All right, here's a chart. Let me share my screen, Namisha, to answer that question, okay? All right, so how should you invest when things are at an all-time high? That's a great question. If you can see this chart right here, this is the chart of the S&P 500 since a little bit before the year 2000, right? 1996 or so. Here's the chart of the S&P 500. And the S&P 500, if you laid the S&P 500 chart on top of the overall stock market chart, they look almost identical. And that's why the S&P is an excellent indication of what's happening in the overall market, right? So the S&P 500 over the last 30 years or so, look at the momentum it's had. Had a dip there, but has chinks and chinks and chinks and chinks, and has gone what? Steadily what? Up. Steadily up over the long term. I think there's a study that says that if you there's no 20-year period ever in the stock market that you would have lost money. I don't know exactly what the study showed, exactly how to say it, but you just don't lose money if you have it for a long time. This is why long-term investing matters. Okay, you could have had money right here back in the year 2004, right? Look where we are today. This is how the stock market has increased. I'm just showing you a real basic general chart. I could go deeper with the chart, but this will work. I'm just illustrating to you that over the long term, sure, you have a big chunk right here. Big deal happened in 2020 when it went way down. Woo. Big thing happened back here, went down. But over the long term, it's going to go up, or it has gone up. It's proven to go up over the long term. So depending on your age, you may say, somebody back here, watch this. Somebody back in June of 2007 said, oh my goodness, should I really invest right now when my ETF is at an all-time high? Well, yeah, it was an all-time high, but should you have invested for a long term? Yeah, because it went way up. Somebody back here in 2020 said, man, should I invest right now? Everything's at an all-time high. Look what happens to the every single thing you see on here was an all-time, well, not everything, but a lot of them were all-time highs. Here's my point. If you're investing for the long term and you have a long-term strategy, all-time high is a figment of your imagination right now in terms of the overall stock market on a long-term basis. Now, I don't know what they teach at the business school. I don't know what they teach at stock market school. I don't know what they teach. I didn't go to any of that. But I do know that looking at the long term of stocks in the stock market, it has a trajectory to go down, up, down, up, down, up, down, up, but ultimately ending up or going up. So if you say to yourself, my ETF or my index fund right now today is at an all-time high, I say, how long do you plan to hold it? If you plan to hold it 5 years or more, you're good. If you plan to hold it 7 or 10 years or more, you're good. But if you plan to jump in and jump out and play this game where you're jumping in and jumping out, you got more things to think about and more things to worry about. That was a long answer to that question, Namisha. I'm sorry. I hope that was a long answer, but I hope that made sense what I'm saying. It depends on a lot of factors, right? Somebody said, "Yes, we are live. We can hear you. Thanks." Okay. Let's see. Somebody said, "I work for the federal government also." Frank Ellis. Frank Ellis, congratulations. Federal government service. Nothing wrong with it. Stocks typically go down during elections time. We already looked at that one, I think. Okay, somebody said AI is the future. Hey, Tyrone in Orlando, good to have you. Probably a beautiful city down there. Difference between index funds and ETFs. Maybe a bad question. Apologies. No bad questions on here, Eddie. No bad question. Index funds are a type of mutual fund. Let me highlight the question because I want to make sure I answer it thoroughly because there's other people that have that question, right? Index funds is a bucket of stocks. ETFs are a bucket of stocks. Index funds are typically considered passively managed. ETFs are considered passively managed. Index funds, one price per day. One price per day. ETFs, they can be traded throughout the day like individual stocks, so their price fluctuates throughout the day. Your bucket of stocks called an ETF, the prices fluctuate throughout the day because some people want to be able to trade, sell and trade, and do all this stuff with ETFs. They want to take their bucket of stocks and trade them throughout the day. That's cool. That's called an ETF. Index funds, you don't trade them throughout the day. They have one price and one price only, right? ETFs might have a few more tax advantages, et cetera, but the whole gist is the big difference is you can't trade index funds throughout the day. Both of them are a bucket of stocks, right? So the price doesn't fluctuate for index funds. It fluctuates throughout the day for ETFs. Hope that made sense. Okay. Is it a good time to invest in silver? I'm not a gold silver guy. I look at gold and silver as more insurance than investments, right? I do think a few weeks back gold was at an all-time high though, at over what, 2200 dollars or so per ounce. But I'm not a gold guy. I'm not a silver guy. I cannot answer that question. So I don't want to answer the question, Muhammad. I'm sorry. Don't beat me up. But hey, I don't know everything. And that's not an area of my expertise. Um, None of this is an area of expertise. I'm learning as you guys learn. Let's see here. There are companies that put together indexes for analysis. Standard and Poor does it. Index is an ETF that buys. Thanks for answering that question. Um, Somebody said, "Oh, you're welcome, Namisha. The only way to lose money in the stock market is to sell at a loss. Never sell at a loss if possible." Yeah, you don't lose money until you sell. All right, I get it. That's true. AI is the post. I'm not sure what that says. Let's say here, when are they cutting rates? The Fed meets July at the end of July, and they meet again in September. I don't know that they will cut rates in July. Everybody is pretty much banking on a cut in September. And so the stock market is reacting today about the future. Remember, the stock market is looking forward. So when you see what's the trends you see happening in the stock market, is the stock market reacting to what it thinks is going to take place down the road, right? So the stock market has built in like a 70% chance that the Fed is going to make their first cut in September, right? So what you see, the activity you see out of the stock market today is generally an outlook on the future. Okay. Let's see. Somebody said, "Are you for ETFs over single stocks for beginners?" 100% yes. Okay, 99% yes. Are you for ETFs over single stocks for beginners? Absolutely. ETFs are an easier way to start to learn and understand the stock market, the trends, and what's happening for beginners, or even index funds for beginners. Yep. There's a lot more to individual stock picking than there is to ETFs, picking an ETF. Somebody said, question, can you explain dollar cost averaging? So dollar cost averaging, what we call DCA, is just simply taking and putting a set amount of money into the stock market at set intervals, right? So your dollar cost averaging is saying, okay, I'm going to take $200 a week and put it in the stock market no matter what's taking place in the stock market. I don't care if the stock market drops all the way down. I don't care if the stock market goes way up. Doesn't matter. I'm still putting my $200 a week into the stock market. That's dollar cost averaging. It's probably the most advantageous strategy for newer investors who are not so savvy, who don't understand how to do an evaluation of a stock, who don't understand, the types of things to look at to get intrinsic value out of a stock, who don't understand free cash flow, who don't understand looking at an income statement, who don't understand revenue, who don't understand debt and a company's debt, who don't understand that the fact that when you look at the food service industry, debt in the food service industry is not the same as debt in the automotive industry. People when you don't understand some of those types of things, dollar cost averaging is the best way to go. You just put money in and you're not pulling money out. I looked at a statistic the other day ago. I put it in one of my videos about if you miss over a 10-year span, if you miss the top 20 days of investing, the top 20 days of performance of the stock market, your investing is like cut in half. I mean, your returns are cut in half just because of those 20 days that you missed. And if you're jumping in and jumping out, you miss those days. And overall, your returns suffer. So you might as well just do dollar cost averaging, $100 a month into the stock market. Steady. Don't quit. Just keep going. That's why I'm a big fan of 401ks. I know some people don't like them. They say they're fake, and you get these 1-minute sound bites on YouTube about why the 401k is not good. Forget all that. Forget all that. Forget all that. The 401k is okay. Nothing wrong with it. It helps you save money. There's a bill in the House right now in America that is going to force people to do a 401k. Nothing wrong with a 401k or something where you're steady putting money in and you're not thinking about it every single day. Right? Good question. Thanks for that question. Hope that answered. Are you sure I should go all in on Nvidia this month? You never go all in with all your money on one stock ever. Right? Never go all in on one stock ever. So all in, not sure what you mean by all in. You got to let me know what you mean by, do I think you should invest in, perhaps look at doing your research first before you invest in Nvidia? Absolutely. Do your research, and it seems to be a pretty solid stock, but you never know. I'm not telling you to buy Nvidia. This is not financial advice this is not stock picking advice. This is trying to make you more aware of what's happening. Right? We're talking about Fed rate cuts. We're doing a little Q&A right now, but we talked about how to invest your money, and dollar cost averaging is one of the things you want to do when you see rates go down, when you see rates go up, when you see the stock market go down, when you see the stock market flourishing, when you see everybody crawling at the fence to get to Nvidia. This is what you should be doing, just dollar cost averaging. Somebody said, how will the stock market be affected when Joe Biden, who's the current president of America, resigns? I don't know. I don't know if he's going to resign or not, but he may. He very well may. It's looking rough for the guy. Let's put it like that. How will the stock market be affected? I'm not sure if it will be affected, and I'm not sure how it'll be affected. Good question. Let's see here. Are you for ETFs over single stocks? Yes, I am. Don't let Trump get there. He's getting rid of all of the government workers who don't pledge their loyalty to him. Yeah, listen, somebody, let me highlight this, because I'm gonna go in this just real quick. Okay. Love me or like me, it doesn't matter. This is what I'm gonna tell you about this question. Somebody said, don't let Trump get in there, getting rid of all. I don't do politics one way or the other on this channel, right? I don't jump on the right. I don't jump on the far left. I don't jump on the far right. I'm more in the middle. I'm looking at this from a financial standpoint. What happens with this project 2025 thing? I'm not worrying myself shameless over something like that. Okay. I'm not worrying myself shameless over a think tank who puts together a big memorandum and markets the heck out of it and gets everybody to know it and gets it out there. Boom, boom. I'm not going to worry myself over that. So I don't trip over things like that. I try to stay focused on things I control. I'm aware of what's going on, but I'm not going to worry about, oh my gosh, and get into panic. No, the whole world is operating off of fear. And I refuse to operate off of fear of what's going to take place and fear of all. I don't get into the fear game. I don't play that game with the far right. I don't play that fear game with the far left. I don't play that game of let me start shaking in my boots because of some document that's floating around. I don't get into that. Right? I don't succumb to the fear. Okay. So without me going into further with that, I'll just leave that right there. so you know where I stand. It feels like the Fed won't cut rates before the election. This could be accused of influencing. Now, the Fed always says that they're not biased one way or the other, but we know in the past there has been some appearances of biasness. But whether they cut rates or don't cut rates, I'm not quite sure if they're going to cut rate. I'm sorry. I'm not quite sure if it's determined by the election or not. I do believe they will be cutting rates. Okay. And some people might say, well, yeah, they're going to cut rates right around the time when the election to help out a certain side of the presidency. I don't know. Right. I really don't know. They may not. Right. Somebody said there's never a bad time to save in silver and gold. Silver and gold isn't an investment. It's currency insurance. Yeah, I see it as insurance too. Somebody said, I personally use index funds over ETFs. That's fine. Index funds are fine to me as well. I'm good with index funds. Let's see here. Roth IRA. Do some brokerages have a higher return than others? Robinhood is 3% match. I'm not sure about that. Good question. Maybe somebody else can help answer that question. Do some brokerages have a higher return than others in terms of Roth IRAs? Robinhood is a 3% match. Let's see. We are 10 years off retirement. Just paid off our house. Congratulations to you, Tressa. congratulations. Now wanting to build up cash pile. Is that paranoid? Yes, that's paranoid. Tressa, I always say only build up enough cash for your emergency fund. You don't have to keep stashes of cash that are under the mattress. If you want to put your money somewhere safe, now I'm not a prepper. I'm not a prepper. Okay, so I'm not telling you from a prepper standpoint. If you feel more comfortable having $5,000 in your house, that's up to you. But I don't suggest people keep whole wads of cash laying around just in case. I suggest you put that money somewhere and make it grow. Have some emergency money, and then anything above that emergency money to help you live on for 6 months to a year, put it in investments, right? So it is kind of paranoid, Tressa. And I'm okay with you being a little paranoid. That's okay. Everybody's different, right? I'm not as paranoid as you are, but I respect the fact that you're paranoid and you're thinking about the future, but it's just not something that I would do, right? Doesn't mean that I disagree or doesn't mean that I think you're bad or wrong. I just think it's just something I would not do, right? Everybody's tolerance level and how they feel about the future and what's going to happen is different. Right. Junk bonds may not pay you back. True that. Question, if I was to start with $50, where should I invest? If you started with $50 and you were looking to invest, I would say a good S&P 500 ETF is great, right? Only cost $1 to get into, whether you get into it on Charles Schwab, whether you get into it on Vanguard, whether you get into it Robinhood, wherever you go. S&P 500 ETF, you can't go wrong. I won't say you can't go wrong. I don't want to guarantee anything, but I would say that's a really good, safe place to have your money if you want to grow your money. You could also, if you don't want that type of risk, you're 75 years old, you don't want that risk, put it in a U.S. Treasury and get you 1 or 2 or 3% back, right? Or put it in the stock in the S&P 500, and maybe you can get about 5%, 10%. But before you do anything, write down a plan. Come up with a written plan. Think about your goals. Think about when you're going to want the money. Do some thinking before you do investing. Do some pondering. Do some reflecting. Answer some questions for yourself. What do I want with this money? When do I want this money? What are my goals? What ultimately are my values and my strategy and my beliefs about money? Start thinking about money before you start acting with money. Start thinking about money before you start investing money. The problem with so many people is they want to do stuff with money, but they don't want to think. And if you start thinking before you start acting, life will be better. Money will be better. Investments will go a lot further. But think about what you want to do before you do it. Put a plan in place, right? Hope that helped you, C-Dub. Miss Reynolds, leave 401k company matches up to 6%. Absolutely love that too. Somebody said, I think NVIDIA is overpriced. That's me. Okay, that's you, because I don't think NVIDIA is overpriced, Jay. I disagree, but that's okay. Let's see here. Buy oil stocks. Just running through the chat, guys, because I wanted to kind of do a little Q&A. If you got a question, put a Q there. I can check it out. I won't overlook it. Appreciate you, Namisha. Question, Big Q, is the NASDAQ Composite 100 the same as the S&P? They're just different companies, right? They're different companies. The way they choose, they're different. They're just different companies that are in there, right? Question, thanks for all you do. Appreciate you, Gigglebox. If I dump a large sum into Fidelity Index Fund, FNILX, several holding like NVIDIA, Amazon, boom, 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 how much should I continue to contribute monthly? That is totally up. The answer to that question depends on everything I just mentioned. What is your goal? What is your strategy? What do you want? What is the end? When is the end? Are you 25 years old or are you 60 years old? Makes a little difference, right? How much extra discretionary income do you have? Do you have other debt? Do you have other investments? There's a lot of things to think about, Gigglebox, in terms of answering how much. How much is subjective to each person. What you put in, Gigglebox, is going to be different than what phases of Angie put in. What you put in, Gigglebox, is going to be different than Miss Reynolds. Personal finance is personal, right? So this is why I cringe a little bit when I hear a lot of personal financial advice being given, because I realize that everybody's situation is different. That's a roundabout way of answering that question, but that's the best I can answer it with the limited information I have to be specific. If you really want to know, come join my other site. There's a link in the description box on YouTube. Hey, we can have those types of conversations and dig deep. I'm thinking about doing some interviews on the channel, right? Bring on some people and really dig into people's personal situation while we have a conversation in front of a bunch of folks, right? And so you guys can see what I do instead of hear about what I do in terms of one-on-ones with helping with people. And you can see how I will break down somebody's situation and have a conversation with them about what they should do, shouldn't do. Maybe this is right. Here's 5 things to think about. Boom, 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 right? Do that all the time, and I enjoy doing it, right? So let's see. Trump's entire staff's been working on 2025, but he doesn't agree with it. Okay, I'm not sure about that. Don't know. People talk ETFs, but my company only has mutual funds in its portfolio for matching. How do you pick good mutual funds? You pick mutual funds, you got to look at the fee. What is the fee? Regular mutual funds. Here's the difference between regular mutual funds and index funds. Regular mutual funds are actively managed, so the fees that it costs to own them are higher because the fees have to pay for a lot of extra administrative stuff that when you go over to a more passively managed investment like an index fund, you don't have those fees. Mutual funds, fees. Index funds are a type of mutual funds that just follow an index. They don't have to have a manager, a fund manager who's figuring out what to put in the bucket and what to take out of the bucket and when to put and when to. No, index funds follow an index, so the management fees are less. So you look at fees. That's one way you can think about picking a mutual fund. Also, look at what's in the bucket, right? So, but fees is a big part of index or mutual funds. Let's see here. Somebody said use a money market for emergency fund, better return than your bank. Absolutely, Kevin. Thank you for that comment. I appreciate it. It was 5 minutes ago, but I'm close, right? Kevin, thank you so much for watching on LinkedIn. Appreciate you being here, bro. Let's see. Market money accounts, market money or money market accounts do offer a slightly higher return than your regular savings account at your bank down the street, but you have some limitations. So read the fine print on those money market accounts if you want to put your emergency fund into a money market account. Let's see here. Let's see. Somebody said, nah, with $50, go buy an investment book. Yeah, that's not a bad place either to start, Jay. You're right. You're right, Jay. That's a good place to start with education and getting and learning some stuff. That's a great place to start. Thank you for saying that comment. I appreciate it. Let's see here. Boom, boom, boom. I'm just kind of scrolling down, guys. Q, how's your workout and healthy eating going nowadays? Appreciate that comment, John. Appreciate you, John. It's going okay. I'm breathing and blinking, right? I'm breathing and blinking. Still trying to eat healthy. Although I did have a piece of cheesecake last night. Hey, whatever. Somebody bought me a Cheesecake Factory gift card, and I used it last night and went out and got cheesecake. And I also bought a piece of carrot cake. But, hey, can't be perfect with it. I will go walking today. I have been walking every single day. I got to hit my calisthenics, though, hit my push-ups and my pull-ups today as well. Haven't done that in about a week, but I'm going to do that today and get my walk in. So I'm trying. I'm going to get out and get some good sun in just a little bit, and that's always good. Let's see. Always encourages me to stay on the right path when I hear about your routine. Fantastic, John. I'll go ahead and post a little more about that every now and then. I appreciate that, and good luck to you on that. Let's see. NVIDIA was overvalued at 140. That's why it dropped. That may be the case, Walla Mala. When it got to 139, 135, it was a little bit overpriced, and then the market told it when to slow down, right? Let's see here. Let's see. $50 with no money. Let's see. If you look at the valuation, NVIDIA is overpriced by the numbers. Perhaps. Question. Is there any way you can go over the funds for postal workers in 401k like seed funds? Okay, let me just run this down real quick, Mike. Good question, Mike. And I'm going to run through it because it's something that I think if you're in the federal government's TSP, it has different funds. Let me just look at them real quick because some people ask me this. I know this is not germane to most people. Ooh, that's a big word. If you ever hear the word germane, man, that's a big word. All right, so let me just type it in real quick, and because I forget what they are. They are the G, the F. Let me look at it. I didn't pull it up yet. The G, the F, the S. Okay, there's the L funds, which are life funds. There's going to be like 1 minute, so bear with me. Life funds are just funds that anticipate when you're going to retire. They have the 2035 fund, means that you're anticipated to retire around 2035. The 2045 fund, the 2055 fund, the 2065 fund. And what happens in L funds is as they get closer to those years, they start automatically shifting what you have inside of your account into more safer places. Safer meaning bonds and things that are returning a lower return, but they're more safer because they don't have the volatility. When you're, let's say you have a 2065 fund, that means you're about 25 years old today. You're going to retire back in 2065, 40 years from now. So they got you aggressively in aggressive funds now. And as you get older, they shift them automatically. I don't like L funds because I like control. But then you have the G fund. The G fund is where they invest in like U.S. Treasuries. Very safe. You only get 1.5% interest on your money. I don't have much money in a G fund. I have these funds, by the way. The F fund. F fund is very similar to bonds. Doesn't gives you a little more volatility than G fund, but gives you a little slightly higher return. Not a big fan of F funds either. Most of my money in the TSP is in the C fund. The C fund is the fund that's basically the S&P 500. That's where I think you should be if you're not 1 year from retirement, or if you want to take a little bit of risk, be in a C fund. Being in a C fund is like being in the S&P 500 index fund. Very, very good place to be. Now, the other one, what is the other one? The S fund is more like for the small caps, right? Small caps, mid caps. I'm not a big fan of S fund. Very little bit in that. Finally got the I fund international. Hope that helps. International stocks. I hope that helped answer your question. It was fast. But I did it fast because I know everybody else doesn't know what the heck I'm talking about. If you're a federal government employee, those are the funds that you have to choose from in your retirement account that's offered by the federal government. All right, Jay. No, not Jay. Let's just. Mark said the Bible says my people are destroyed from lack of knowledge. If you're too lazy to get educated about investing, you're surely setting yourself up for failure. Absolutely, about anything. What do you think about VT? I haven't researched it. I have to research it. Smart money, bro. I haven't seen a phone like yours in your background since my sister had one in the 80s. Love it. The beauty about this phone, I like it because it has a ringtone on it that you can turn up and turn down. I've had it about 20 years. And I'm not sure where it was before that, but I had it for 20 years and it still works. I have a landline. Don't beat me up. I'm old school. It actually, and it has a volume on it too, on the nozzle. Right? See, it's got a volume on the nozzle. You turn it up, you can hear better, etc. Oh, speaking of hearing better, let me tell you guys this. Big news on Tuesday. I am getting a hearing aid on Tuesday, right? People say, "Well, why are you telling everybody?" Because I don't care, I don't. My hearing has not been good, so I went out and had a deal, and boom, got one coming. So if you know anything about that, shoot me an email or shoot me some in the comments or something. Let me know. Somebody says I currently have 350 shares of NVIDIA and about 25K to invest right now. I plan to DCA going forward into VTSAX and VGT. Those are solid. VGT is technology. VTSAX, I think, is the overall market, maybe. Let's see. Question. I'm a federal employee in a SIRS. So you've been around a long time. Would you consider the money automatically withheld for retirement, not TSP, a part of your net worth? Yes. If you got money sitting around that's automatically, you're saying pension money. No, some people want to put pension in there with their net worth. I don't put pension in my net worth because the pension, who knows how long I'm going to be receiving a pension, right? Who knows when I'm going to perish, right? So I don't consider the pension money that you might have a part of your net worth. I don't. Some people may. All right. So let's see here. Amazon Prime Day is coming up. Let's see. I just bought several shares. Let's see here. That's cool. Do you think Tesla's going to go to what happened? I don't know where Tesla's going to happen. I don't invest in Tesla personally. I'm not a big fan of the CEO necessarily. He's a little too much for me, but that's cool. I don't care about his politics necessarily, but it's the personality thing that I'm thinking. And I don't really. Their cars are ugly to me. I don't like the way their cars look. I try to be an investor that wants to invest in things that I like, things that I enjoy, CEOs that I think have a good outlook, etc. I don't want to be the person that's investing for something just for money, right? So if I don't use Apple products, I don't invest in Apple. I don't use Tesla products. I don't invest in Tesla, right? Now, that's the way I think. You don't have to think like me. But in terms of my money, I want to put my money in something that I want to win. I want to win. I'm going to put my money in something that I believe in and I think is going to win because XYZ, right? So that's just my own personal philosophy. That's part of my strategy. So when you go over to the other website or the other our membership channel, and you can click on it, it's the first link in the description box below. When you go over there, you'll see the first video up that I did last week talked about here's what my investing strategy looks like. Here's the preliminary original version of the things that I think about in terms of my core values and core beliefs about individual stock investing. That's where we're going to do more of that over there. So you can join us over there. That's cool. Don't forget, guys, I don't mention it much, but check out Mint Mobile in the description box of this video on YouTube. Also, check out some other free stuff in the description box below as well as some other videos that might be of interest to you. This one's a long one. I don't mind a long one sometimes, guys. So some people tell me, man, make these videos shorter. I say, man, I got too much to say. Let's see here. Hey, what's up to you, Validated? Appreciate you being here as usual. Let's see here. Ohio, nothing wrong with that. Let's see. That's good. You're taking care of your physical health and your financial health. Absolutely. Physical health, spiritual health, mental health, financial health. They all matter, right? They all what good is it to be here in 10 years from now with a whole bunch of money, but you're not in good physical shape? I know some people have natural ailments and things that happen to them. This is not an indictment on you. It's just to say, I'm going to try my best when I'm young to take care of the old me by keeping myself limber. I'm not as, I'm 54 years old, or not 54. I'll actually be 54 tomorrow. I got a birthday tomorrow, believe it or not, but I'll be 54 years old. As a 54-year-old person, hey, I got to do some things a little different to keep my spiritual. Don't forget the spiritual. Keep my spiritual. And, that's just is what it is. And I'm a Christian guy. I don't talk about it a lot on this channel, but yeah, I'm a Christian guy. So I believe in keeping my spiritual self together as well as my mental self, as well as my physical self. All those things matter, right? Lyle's in the house. Lyle is the one that said that. You throw me off with the name, Lyle. Good to have you here, man. Appreciate you being here. I appreciate you being here. I'll be giving you a call shortly, man. I'm gonna dig back into my genealogy. Elon is gonna be mad at you if he finds this. I don't care. I don't know anything about Elon. I'm a person that I don't pander to politically correct this and politically correct that and all that type of stuff. I'm more of a, I can handle it. I can handle it. Agree on Tesla. That's good advice. Invest in what you like. Yeah, that's just what I do. And everybody doesn't have to do that, but it's just what I feel is good, in terms of my values and so forth, right? Because that matters. You're welcome, Mike. Let's see. You limit. Yeah, one of the dislikes. This is a good point. I'm gonna highlight this, Mark. One of the dislikes about 100% 401k investing is you're limited to the stocks the company allows, which aren't the best for returns most times. I only invest up to the match, not $1 more. Mark, that's an excellent strategy. It's great. I'm glad you said it. Thanks for bringing that to everybody's attention, because you're right. A lot of times, this is what I tell people. If you have a 401k, the first thing you got to do before you go invest in a bunch of your money somewhere is first go figure out where they're putting your money that you've been putting in for the last 5, 10, 15 years. What are they doing with your money? You may not like it. You may want to change the choices, right? They may have you in some super duper safe, the default. And sometimes the default is the most safest, lowest returns of all time. And you're stuck there and you didn't know it because for the last 10 years, you've been getting the match and putting a whole bunch of money in and you never stop to think. The first thing you got to do is take a look at where your money is currently going in that 401k. Pull it up, pull up your account so you can see. You got to get that knowledge before you go do anything else. Great point, Mark. Thank you so much for bringing that out. I certainly appreciate it. Let's see here. Let me see here. Boom, boom. We got some good stuff in the chat. QQM is really not doing really nice too. Yes, they are. Let's see here. 1970. Congrats. Yeah, 7. Okay. Can I give you guys a statistic? I was born 7/7/70. And I was the 7th child that my mother and father had. And I was 7 pounds, 7 ounces when I was born. And Back in the 90s, I taught seventh grade for 7 years. Lots of sevens in me, right? Go figure. So appreciate the happy birthday. Thank you so much. I appreciate that. I didn't even think to mention it very much. Let's see. Question: Do you still do one-on-one meetings? How much does it cost? C Dub. If you join the other channel and you join it at the as a VIP on the other, not the other channel, join the other website, which there's a link, the first link in the description box below this video on YouTube. If you join that link, you can have 20-minute conversations with me about your personal finances for only $24. Sometimes people don't advertise the price. That's cool too. I don't mind. I'm an open book. You can join me and support me over there for $9. You can join and have a conversation once a month for 24 bucks a month, or you can go and do a one-on-one with me, and you can get that information in the description box below as well. There's a link to that too. You can do a one-on-one for an hour and a half, 2 hours with me. In fact, I got a one-on-one coming up here in just a little bit. So it's available to have you. And I do the one-on-ones because personal finance is personal. Maybe you look at Fed rate cuts and you say to yourself, well, here's what's going to happen. Here's all I have. Well, how is what I have going to be affected when the Fed cuts the rates? It's going to affect your stocks in the energy industry, maybe a little different than it may or may not affect your stocks in Chipotle, right? Or in technology. So you get a chance to have more of an individual one-on-one conversation, and you can really pick my brain about anything, right? I don't care. We can have a conversation, but I got to charge you for that time, C-Dub. So that's how you can get more one-on-one with me. I appreciate you asking that question. Elon is too much of a Trump supporter for me. I don't know. I didn't even know that. I didn't know that at all. You'll see, I can control what my 401k money goes into. There's a default, but I changed it to my liking. Excellent point, John. Let's see here. Ohio, let's see. 7 is the number of completion. Boom. What's that mean? You watch Smart Money, bro, or watch me and I complete you? I don't know what that means, but yeah, that's cool. I think biblically speaking, yes, 7 is number of completion. Then you have a number of new beginnings, etc. You're right. Happy early birthday. Thank you, AJ. Appreciate everyone isn't a Christian. Buddhism is better for me. That's cool. Listen, I don't force anybody to believe what I believe. That's not what this channel is all about. That's not what I'm all about as a person. I can respect, love, honor people who are different than me. That's the kicker. I don't expect you to be far left. I don't expect you to be far right. I don't expect you to be the same religion as me. None of that matters. We're talking about money, right? We're talking about growing your money. And growing your money can happen for you, whether you're Hindu, Muslim, whatever you are. It doesn't matter. Christian, it doesn't matter, right? We're talking about how to better your life. And bettering your life can include all different types of religions and colors of people. It doesn't matter. That's what we're talking. That's what this channel and that's what kind of I'm all about. I'm not looking at one agenda. The agenda I'm looking at is helping you get better with your money. Make more money, grow more money, invest more money, earn more money, have more money, pass along more money. That's what we're talking about on here, right? Let's see here. Wait, is the one-on-one is either phone or Zoom. You choose. You choose, right? My opinion on Palantir. Palantir is a company that we did a video about. Palantir had a whole bunch of government contracts. Now they're trying to get into the commercial world. Maybe Palantir's on my watch list as a stock. It's on my watch list. Let's put it like that. I think they have some good thing. Again, they have one of those CEOs that's kind of out there, doing his thing and kind of likes to make things, more about himself sometimes. But it's also a solid company in a lot of ways when you look at their fundamentals and when you look into the usefulness of what they do in the commercial world, right? I think it's a very interesting company. Appreciate the early birthday from you free thinkers so much. Listen, guys, I'm going to let you go. I just wanted to give to you what you should be doing. And if you didn't get it before the Q&A, scroll back through to about the 5 or 10 minute to 15-minute mark of this video, and you will see what does all this mean that's going on with the Fed funds rate. And I try to explain that in a language that is a plain language, and it's not overly complicated, and it's not with me speaking over your head. I want to speak directly to you and have conversations with you guys. And I can do these economic videos in 10-minute sound bites, right? But sometimes I think these things are more beneficial if we come together as a community and have the conversation over the long term, over a good 30 minutes or hour and a half or whatever it takes, right? So I appreciate you guys being here. Listen, 7 things I want you to keep in mind. Make sure you have an investment plan of action, that you have your own personal idea about, that has your strategy on it. Make sure you be consistent, right? Over a long stretch of time. Don't look at the stock market as 3-month intervals or 6-month intervals. Look at it as 3-year intervals and 6-year intervals, right? Only invest in what you understand. If you don't understand technology, if you don't understand AI, if you don't understand what's happening in that space, learn about it, read about it, understand it, and then invest in it. If you don't understand the healthcare administration and pharmaceutical space, don't invest in those things. But if you want to invest in them, then just go out and learn about them. Somebody said earlier, the best place to start with your money is to start with a book. That could be exactly right. Start with something, start with reading and getting the knowledge. Only invest in what you understand or ultimately understand, what you come to learn, right? Diversify. Don't slip on some of the other types of investments. Don't just all be in single stocks. You can be in ETFs and single stocks. Maybe you can look at real estate, right? Maybe you can look at REITs, whatever it may be. Maybe you can look at bonds if you want to be a little less, a little more, little less risk, a little more risk averse, right? You know, but the bottom line is, do not panic and do not go with the crowd. When the interest rates go down, everybody is going to say yes and start and go this way and start buying and start spending. Maybe you need to go this way and be different than the crowd. Okay? Something to think about, guys. I hope you guys enjoyed our our long talk today, right? I appreciate you being here. The channel wouldn't be what it is without you. Don't forget to hit the like button. I haven't said it in a while, but do me a solid. Please do me a solid and just tap that like button for me. And share this video with somebody you know, somebody who's interested in investing, somebody who's trying to make sense of some of this macroeconomic stuff going on with the Fed funds rate, with the interest rates, with unemployment that we found out yesterday was going up 4.1%. Share the video. The best way to support the channel is not to buy anything from me. The best way to support the channel is not to purchase something for me. I don't sell anything but my time at this point, right? The best way to support the channel is to share the video, right? With other people. Free information, free game. I appreciate you guys. Thank you so much for being here. As I always say, the best person to take care of the old you is the young you. You guys take good care of yourself and take care of other people. Until the next video, peace.